Hello and welcome to STMS Forex Daily Video Recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, June 24th, 2010. In yesterday's session, we had the FOMC conclude its interest rate meeting, and in its statement, it downgraded the assessment of the U.S. economy. It said that current financial conditions have become less supportive of economic growth on balance, largely reflecting developments abroad. There's weakness in commercial real estate, and the labor market is improving only gradually, which is constraining household spending. In addition to the weak new home sales data that we saw yesterday, it left the impression that the Fed will keep interest rates at a record low until next year in order to support growth. While the news that the Fed will keep interest rates lower gave U.S. equities a pop for a short time, it does increase overall risk aversion as it means that global growth will be slower than expected. It's also bad for U.S. yields, as the sense of risk aversion means that more people will buy U.S. Treasuries, pushing down yields. Therefore, let's take a look at the US dollar-Japanese yen pair, as it is closely correlated to the spread between US Treasury yields and similar yields in Japanese bonds. As we can see, the last three sessions have seen the pair decline sharply, following our move below the 90.90 level at the end of last week, though we moved above that, but then fell back down again after we tested this level of resistance here. We could actually draw it back all the way to this high from June 4th. Now we come close to testing pretty much a 1 month low for the pair after we had hit 88.90 in May 19th. The 2-year spread between US and Japan is very highly correlated with the dollar-yen, and that spread continues to contract. A Japanese investor picks up only 51 basis points in yield, well below historical average, with 200-day average at 70 basis points. So what to look out for here is if US Treasury yields do begin to rise, so could this pair. Now, taking a look at the euro-dollar pair, we have some cross currents following the FOMC announcement. Yesterday, the dollar was pressured following the FOMC news, as the promise of low interest rates means investors can continue to use cheap dollars to fund bets in higher yielding assets such as Australian, Canadian, and New Zealand dollars. Overnight, we had the euro decline against the dollar as we had fresh worries about the eurozone sovereign debt, especially coming from Greece. But then we rebounded in New York trading despite pretty weak equities, though we did have slightly better than expected U.S. economic data. We even managed to move above this 1.2350 level of resistance. Now, this could be a case of short positions being squeezed out, as the move seems rather inconsistent given the recent widening in Greek yield spreads and weak equities. For instance, Greek 5-year credit default swaps hit a record high today of 958 basis points. We had the Greek Prime Minister say that the banking system must take strategic regrouping steps, which might mean consolidation along the lines of what is happening in Spain, where weak banks are being merged out of existence with help from the Bank of Spain. So while today's U.S. data doesn't necessarily mean risk appetite, and we did have U.S. stocks falling throughout the New York morning session, let's take a look at that U.S. data. First up, we had initial jobless claims fall by 19,000 to 457,000, which moved us down from a 2-month high that we had seen the previous week. It was also better than the 7,000 decrease expected by economists. However, as we can see from the chart to the right, we continue to be stuck in this sideways range in terms of jobless claims, which is inconsistent with a decrease in the unemployment rate. It was the second report that may have helped some risk sentiment, as durable goods orders fell by 1.1% in May, which was better than forecasts of a 1.5% decline. It also follows 5 consecutive months of gains, so while that seems like a pretty negative number, the figure is slightly misleading. If we take away transportation, which includes cars and airplanes, durables were up 0.9%. In April, aircraft orders jumped 216%, while in May those orders were down 30%, so that makes up for a large difference in the transportation sector. Also, if we take a look at a closely watched indicator of capital spending, which is orders for non-defense capital goods excluding aircraft, the news was good as it increased 2.1% in May after falling 2.7% in April. Over the past 3 months, this indicator of orders has climbed at a 29% annual pace, up from 21% in April, and that's a sign that companies are ramping up investment in machinery in anticipation of increased production. Now, as I mentioned, U.S. stocks were pressured today, and the Dow Jones Index, for instance, was down triple digits as of 12:30 p.m. Eastern. Therefore, let's switch over to one of our commodity currencies, the US dollar Canadian dollar, which are one of our risk-on currency pairs, in that it rises when we have risk aversion, or it goes up in favor of the greenback, while it falls when we have risk appetite, which means it moves in favor of the Canadian dollar. Prior to the FOMC statement, we had the Canadian dollar weakening as it had a combination of weak retail sales data and we had some very weak US housing data which pressured risk sentiment. Following the FOMC statement, we saw the greenback slide, so that corresponded to this move in favor of the Canadian dollar, but overnight we saw the Canadian dollar give up its earlier gains and the pair retested the level around 1.0460. So at least from this pair we see that risk aversion has been very strong in the last several sessions, as this pair has broken through this one level of downward sloping resistance. And if we zoom back even more, we could draw a second trend line that was broken over the past two sessions as well. And look at another one of our commodity and risk on pairs, the Aussie US dollar. Here, a move in favor of risk aversion means the pair will go down in favor of the greenback. So overnight, we actually saw a rather sharp slide on the back of increased worries about the global economy and the Eurozone. So here too, the last four sessions have seen the pair move in favor of the greenback, though we did bottom at around the 0.8640 in the early New York trading. Zooming this pair out to show more context, we see that we've had a very strong rally in this pair the last 2 weeks as our risk on trades fared very strongly, but then now we are seeing a correction to this upward move. Now, we did have a change in the Australian politics as the country appointed a new Prime Minister. Julia Gillard becomes the country's first female Prime Minister, replacing Kevin Rudd. Rudd was forced out by a mutiny in his own Labour Party in a move seen by many as clearing the way for potential back down on the controversial mining super profits tax proposed by Kevin Rudd. That could be a net positive for the Australian dollar, as it means that mining companies will be more likely to invest in Australia if they're not facing a big tax. In a final pair for today, we look at the pound dollar, which managed to hold its gains from earlier in the week and bounce up off the 1.4930 level, which it tested overnight. The pound has been one of the best performers this week as it has been gaining strength since the UK released a belt-tightening budget, which two rating agencies said could protect the UK's AAA credit rating. We had some rate hike chatter coming from following the Bank of England meeting minutes yesterday, which helped to push the pound to a 6-week high against the US dollar, and it's also its highest peak against the euro since November of 2008. Taking a quick look at the euro-pound pair, we see that we pushed below this important level of support. However, in New York trading, we've seen the euro be very strong, which right now we might have to wait a little bit in order to find out exactly the reason, as it could mean a major player was exiting their positions or was short squeezed out of the market. So that's it for today's highlights. Let's take a look at what to expect to close out the week in terms of fundamental releases. Tonight we get New Zealand trade balance data, as well as the Japanese consumer prices, and overnight Germany posts a measure of its import prices. Tomorrow from the US we have the final version of first quarter GDP, as well as the final version of UMich consumer sentiment for the month of June, though both of those may not have much impact on risk sentiment, since we already had the preliminary readings. And that will do it for today's broadcast. For more news, videos, and analysis, please visit our site, cmsfx.com.